This is our first edition of DS Roundtable, in which we take the entire team of Damp Spring and talk about what's on our mind, what we're working on, what we're looking at, and in a perspective of the next month, longer term, not short term, and perhaps even multi-months or even over the course of the next year. And we come back to you once a month and update our thoughts. And it's a chance for you to get to know us, to see how we think, and we hope you enjoy it. The team here is Jimmy Jude, Nick Lenz, we have Ben, and Daniel is not currently here, but he'll be a regular. He runs our DS data product. So I'll try to kick it off. So we got lots of topics that are, to me, seem fairly important in terms of the thinking about markets and how to invest. I think we should probably cover at some point the way we think about investing. But for now, let's talk about the topics that are on our minds. And for me, what's on my mind is obviously the path of the economy, the steps that are going to be taken or likely could be taken by the administration and the global fiscal policy decisions. Obviously, what's happening with the central banks, and in particular the U.S. central bank with the Fed. And then I'm focused a little bit on the implication of SCOTUS and the decision on whether tariffs are illegal or not. What are you guys thinking about? Jimmy, you want to kick us off? What's on your mind?
Yeah, with the fresh new year, I try to keep my eyes on the way the flows shoot out of the gates. Going into the end of December, we had some themes out there. We had a grinding stock rally with a couple hiccups here and there. Nothing crazy for Santa. We didn't end on any high note by any means. There were some themes out there, one of them being vol really getting crushed at the end of the year and staying really cheap. Front of the VIX curve staying very steep. So when I look out on the tea leaves going into the new year, I think what is going to derail this? It seems like the entire world is bullish. You know what? It's always been my job to look out on the tea leaves and see what's closest to derailing this thing. And when I look out, it's got to be the back of the yield curve that is most glaring to me anyways. A lot of things are pointing up. I think on a long-term time frame, we've been consolidating up high in equities on the charts. The charts don't have anything glaringly bearish about them. The rest of the world charts really got off to a strong start on Friday and have been making very bullish patterns themselves. So there's nothing there that I see. The only global equity chart that still looks a little sketchy is probably the EWJ, Japan's chart a little bit. But even that one is starting to recover a little bit. So I look out and I think, geez, I'd love a retrace. I'd love to see some of the market give some of this rally back and check back and be a little healthier than it had been. And the only thing that I can see is the back of the yield curve right now. It still is in a dicey spot on the charts. Yields are right there at their range highs. The price right on their lows, near their lows in bonds. The fly in the ointment I'm really going to keep an eye on early going on is long-term yields. I think that's the thing that can maybe scare everybody. I feel like last year, a lot of the rally, after Trump really gave up and really started to taco, a lot of the rally started around 5,700 with the meeting in Geneva. And I felt like the administration was able to jump a key resistance area on the charts with this big announcement that we have this China deal and rare minerals and everything was terrific when it really was predicated on bullshit. And we jumped a very important part of the chart on that day. And I felt like a lot of the rally since then was predicated on bullshit too. Like during Thanksgiving, we had a lot of weakness. And they floated the Hassett balloon. Yeah, we got a weak dollar off that announcement. But we also got a curve that's steepening wildly and the back end not coming around. And that's really what they need to come around is the back end. probably the thing that they're most worried about is in the economy, or the thing I'm most worried about is probably housing. So they need that back end to comply, and they're not getting that. So it just seems like there's a lot of BS underneath this market, and I'd like to see it back test that BS. And I think the market that could cause it to back test is, if there's one thing that they can't bullshit their way through, it's the bond vigilantes and just floating easiness and look at how wonderful everything is. We're all at all-time highs, because that only adds to the weight of that. So, and I don't think this administration, I don't think Trump is used to the quandary that he's in, where you don't really want to be blowing sunshine at the market right now, where the bonds are on their charts. You're just going to push them over the edge, and then you're going to cause a reaction. And I'm not sure how you fix this either.
So my question on that, and then I want to hear Nick's thoughts, but my question on that is, do you actually think they care about the bond market?
I think if they don't care about the bond market, they're going to have to care. If they ignore it and we dump through these levels, I think that equities are going to start caring and reacting. The one thing that worries me, let me ask you, you've done it longer than me, but how do you stop this flow? How do you stop this negative flow in the back end? You can't really jawbone it. Not in the way they're jawboning the market, because they're jawboning, hey, lower rates are on the way, we're going to stack the Fed with easy guys. That's not going to get it done. So how do you get it done? How do you stop this? Do you create a situation? Do you let one fester? That's the only way to clear out the decks.
To
right?
me, issuance need. There's no doubt about it that the government needs to finance itself. So they're going to be selling bonds. You've got this private sector need to lever up to fund AI infrastructure, and for that matter, any onshoring infrastructure. So I don't think you can to change that. You need to either spend on the government side, you need to spend less or tax more. And so I think spending less and taxing more would rally the bonds. But that's a question of whether they will spend less. I don't think they could spend less. That's a possibility. That, I think, is a political potential for the next 6 months, is you're going to get a reconciliation bill. And as we saw in the last reconciliation bill, they were able to slash Medicaid, SNAP, etc. You can tax more, but I don't see any potential for that from a legislative standpoint. The only potential for that, to me, is increasing tariffs, which we don't know whether they're going to be legal or not. So those are some things. And then otherwise, bonds respond to falling inflation and lower growth. And so you have to slow the economy down to get the long end to respond. Anyway, that's my thinking on that. Nick, do you have any thoughts?
Yeah. So when I think about the market, I try to think about it in 3 sections, really. So number one, I've accepted a long time ago that I don't think like a normal person. I've never been able to ride the waves of retail or figure out what people are thinking. So I have the 3 sections. The first section I try to think about is what is the basic sentiment around stuff, not what I think is going to happen, but what I think that the vast majority of people is thinking going to happen. So I don't think this, but this would be like the run it hot type narratives, things like that come out, right? So I try to think of, then I have the systematic side where the computers tell me what I should think, and then I try to meld those two together. So from a sentiment standpoint, I think the basic sentiment is that heading into the first quarter of 2026, we're going to have the OBB stuff start to kick in. We're going to have the tax cuts. We're going to have us sort of a relaxing of financial conditions. We're going to be in a Fed cutting cycle. And you add on this Venezuela stuff. You add in in the last 4 years, we just had the lowest gas prices. We have the housing metrics and the inflation metrics, how they're lagged. So they've been constantly lagging with the rent adjusted rates. So those are going to keep rolling in. And I think we're going to have this sort of temporary deflationary force in the numbers come through. And so you add those things together, and I think that's what people think is going to stabilize the bond market, especially the Trump administration. And then as you go through that, you're going to have this impulse to buy dips in stock indices. Now, do I think you should buy today? I do not. I think we're extended. I think a lot of the AI names need to cool off. And because they're such a large part of the market, they really can't sell off and equities go up. No rotation is going to be able to keep the market up. But I think that this produces essentially where we get these headline driven risks and we go down fast, but we also recover fast because the underlying sentiment around markets is that we have these positive OBB, we have the deflationary forces coming in, we have the taxes, and we have the financial easing with the Fed. And I think that creates if we go down a couple hundred points, that people will want to get reinvested. And that's how we'll go chop down, go back up, chop down, go back up. And that will be the beginning of the year. If I had to put it on, I don't know for sure. We have the SCOTUS decision that changes everything. If they come in and say tariffs are illegal, we got to rethink everything. Because we lost essentially the tariffs are a consumption tax. It's a clever way to raise taxes. And when you think about it like that, it's it makes sense that they went that way. But if those are taken away or if they're adjusted, I think we can go over that. But I think that view starts to go. But that's my main idea, that inflation will have a deflationary impulse come through in the short-term metrics. That will lead to a stabilization of the bond market. And then if that can happen, dips will be buyable in the stock indices. But I wouldn't chase, because if the AI names sell off, there's no amount of rotation that's going to keep the market up. So I think we could really get these chops down or these scary days down. But I think that in the long run, you would want to really look to buy dips, raise cash on the rallies, and then look to buy dips into the stock indices and risk.
Sure. The thing I'm thinking about on equities in particular is, listen, we can be bullish or bearish in the next month or two, and that's what our jobs are. But when I look at equities overall, and I say, how's the year going to be for equities? We're growing at a 10% earnings growth. And that's a lot of accrual of equity. Even if you get a multiple contraction of 2 points, 2 multiple points, you're breaking even. So when you think about owning equities, and I do this, I'm constantly thinking this way. When you think about owning equities broadly, I agree your points about rotation and the specifics in the stock market, but when I look at a macro level, it's tough to be bearish equities for a year. Maybe they don't even earn 10%. Maybe they earn 8% or 7%, but they're going to have sizable earnings. And so that's a tailwind for equities that makes me think, to your point, you always want to be buying dips in equities. The question, I guess, is there what drives multiples?
Yeah, I think in order for that the back end has to stabilize. And I think the back end stabilizes, one, if Trump decides to pick a more neutral Fed chair. Now, I'm not a Trump whisperer or anything. I just try to think how he thinks. I always think he's trying to push that Overton window too far so that he can get people in line and then pick who he wants to pick. Is it going to be Hassett? I don't think it's going to be Hassett, but it definitely could. But I think he's going to go with a more neutral pick,
I agree with that about Trump. Let's talk about that. So let's say he picks Hassett. Does that hurt the bond market enough to?
I think bonds snap down on that. Yields up
in price. Down. Jimmy, what do you think?
And the reason I brought the point up too is just because being a chartist, I look at the sensitive areas that we're at, and there's not a lot of support underneath these areas in 10s and in 30s. We had really big moves in July and Sep coming out of rallies that really left no support. And we're starting to creep into those areas. And that's why, honestly, if he makes a mistake at this point, they will kick him off the edge here. And I think the speed of rates will be the thing that has potential to spook the market. I don't think he has a lot of wiggle room here to...
Okay, so does that mean he's not going to pick Hassett?
Yeah, I don't think he I don't think he does. And if there's any market out there, it hasn't showed up that he's backing off this. Maybe it's because there's more than one issue than just the Fed pick in rate land. But I know I've seen Dixie stabilize a little bit, break. It's had a pretty vicious downtrend since he floated Hassett, but it's started to break that downtrend and stabilize a little bit and been showing a little bit of life on the bottom. So maybe that's the first tea leaf that's starting to show us that he's going to be backing off that pick. I don't think he can go there. I think Bassett is going to say, listen, you just can't do this where the bond market where it's at and what's happening with the curve right now.
So of the people who you think who do you think he's going to pick? Because we have Waller, which I think would be the best pick. We have Warsh, right? Correct? That's
Warsh.
Yeah, Warsh. Now he's like a very hawkish guy in this past, but he probably is going to play the line. But it seems more like a trap to me. Maybe not Trump, but maybe a Besson would be like, do you really want to pick this guy? Because is in his heart, maybe he was lying back then, but he was a pretty hawkish dude in his past. So
I'd like to think Warsh is he was a governor. He had a couple of fairly out of consensus for the Fed views at the time, and they wouldn't line up with what Trump's rhetoric has been. So I see what you're seeing, but I also think that it's really hard to pin him down to his history and say that he's going to be hawkish. Maybe he will be, but I think it's trickier to do that. So I don't think that his prior behavior would disqualify him. I happen to agree with you. I think Waller's the best pick. He wants to cut. He respects the bond market and isn't going to do anything rash. And he's going to be perceived as being independent, so to speak. And what the administration has to rest on is his fairly and consistently dovish behavior for years now. He's always been not quite as dovish as Williams, who's dovish for unclear reasons. He's been dovish in a very articulated way and been smart about it. So I think that would be the best for the long-term bond market. I think Warsh just is a little bit riskier, but not awful.
So that's just my point. I think Waller, bonds stabilized, everything is good. Hassett, they go down. Warsh, that's why I'm saying he's a middle ground. I really don't know what's going to happen in that scenario. I is he going to be a puppet? Is he not? I don't know the guy that well. But of the two options, that's why it's like I would pick Waller. But those two picks, I have a rational plan for. But the Warsh is sort of something I don't know what to do in that situation.
So speaking of that, I think we're unanimous in the view that maybe not. I think Nick and I are on the same point regarding rate cuts. Currently, the trough rate for SOFR is still north of 3, and by over the next 4-ish meetings, January through June, in which Powell is no longer chair in June, you only are priced for 55 basis points of cuts. I think Nick and I at least are on the same page that more cuts are likely than that. Is that right?
Yeah, I'm 100% on that. I don't know what Jimmy's think, but I think that in general, as long as, especially more of a technical, I keep saying like deflationary forces. I'm not saying that there won't be any inflation. I'm just saying how it's calculated. It's now we've entered the time where the rents, everything is going to roll off. So they have the backdrop of inflation, so they can cut. The housing market is semi-locked up, so they do need to open that up a little bit. We're not falling off a cliff, but we also don't have the same immigration impulses. We don't have the same growth impulses. So if they don't loosen and tariffs don't bring in the proper amount of income or whatever, we are going to get into a problem to where they would have to increase the process. So it's like, why not just put in 2 or 3 rate cuts? Why not just get out of it? You can always raise the rates later. And then as long as you have oil cooperating, as long as you have the rents going down, they have no backdrop to say that they can't be focused on the employment market. And the only real thing against them is these kind of weird initial claims numbers that keep coming out very slow, very low. But, it's like, if we were to think about it in the past, when they went for the 50, we have like that SOM rule type thing where it went up by 0.05 or whatever, or 0.5. We are clicking up on the unemployment tick by tick by tick. And so I think that they want to stay ahead of it and they're not worried about inflation. I agree with that stance, but I know that a lot of people think we're entering an inflationary decade or whatever. I don't think that, but it could be a mistake, but I think that's the trajectory that they're on.
Andy, what did you think of the GDP number that came out? Where do you think the economy is right now?
Yeah, so I'm really struggling with like incorporating the reported data into my process right now. Firstly, I think I should step back and say I don't generally extrapolate or take much from data. What I use data for is to say, okay, so we have all this data over these decades. How does data, given what happens to data and what happens to markets, how does it work? And then I test that to see, well, okay, but falling GDP over a period of time generally means bonds rally, bonds outperform stocks. And so I test that, and it generally turns out to be true. So then when I get the data, mostly I consider the current data as not confirming of anything. Like, I just don't extrapolate things and say, wow, we get a low print in GDP or a high print in GDP. That means the economy is going to go higher. Like, it certainly had been, but it doesn't necessarily mean to me that I extrapolate it as going to get hotter. I look at more the policymakers' decisions and how economies work more so than I do the data. So look, then add on top of it what I think is stale and basically differently collected and calculated data. You can't look at the inflation data. You can't say definitively that these numbers are as accurate as they have been when we know certain data was not collected and was, in the case of the 1/6 of the housing in the CPI report, was literally zeroed out. And so I don't have as much, firstly, I don't consider data to be a very good actionable signal. I do think data over the long term is essential. But nowadays, I'm particularly uncertain about any current data. So then I look at what the whole sets of data that are out there. I look at extremely strong fixed investment in infotech and software. I look at contracting non-residential investment, which is factories. I look at, which to me says that this onshoring thing is not happening. I look at residential, and that's very soft. And I think those are important. And then I look at consumption and real wages and all the various, like, there are many ways to calculate all this stuff, all the ongoing calculations and what we see going forward, and tie it to jobs. And my central case is that the economy is weakening from a very strong third quarter, and that, along with the other things Nick mentioned, is disinflationary and should give the Fed plenty of room to ease.
So
What do we
I pulled up the SPY chart and the equally weighted S&P 500, and bringing this back to what Jimmy said at the beginning, how, since the S&P 500 is so top heavy, does that make it easier to keep price elevated in terms of the Mag 7?
The more concentrated a market is, the more at risk of a larger tail event there is, right? Because if some type of bad earnings comes out and is to hit the big stock, obviously that's going to go down. And if they were all in these little stocks, they're going to put that money elsewhere. Are they going to rotate it into cyclical assets? Are they going to rotate it into a different sector? Are they going to rotate it into healthcare? Are they going to rotate it into defensives? And wherever that rotation is, the speed at which it can happen and how fast they can do that is what's going to be able to lift the market, or if the market is going to crash. When you're talking about so much money in big tech, it's going to be very hard to rotate that into smaller stocks without disrupting the price. It's going to be very hard to make a decision. If you're going to get out of the AI names, you're going to go into bonds. If you're going to get out of the A names, you're going to go into commodities. You're going to go into some bigger markets where you're not going to be able to rotate into something like a small cap stock. That's going to be more of a theme that generally progresses over time. So if you have a very concentrated market, the tail risk is going to go up. But you also have that buy the dip sentiment and stuff like that. So you have this rabid crowd that has FOMO that's going to want to get back in. So that's what keeps those stocks going up. But once that fades, then you're going to have a hard rotation out of those assets and the market is going to be more prone for crashes. So the more concentrated the market, the higher the tail risk, but also the more FOMO and more extension you can get. So you have the double tails getting wider.
I wanted to come back to this idea. Both Nick and I, and Jimmy's concerned about the long end of the bond market. That we're all concerned about the long end of the bond market. We're concerned about who the Fed chair is. Nick and I are cautious about growth and inflation, possibly a disinflationary influence, though there are some pro-growth things as well. I want to come back to this idea that the Fed is like, we think the Fed should cut at least as much as priced, and yet precious metals are skyrocketing. How do we bring all that together? Like, what does it mean to you why are precious metals suggesting essentially that the interest rates provided by U.S. dollar, the returns provided by U.S. dollar assets are unattractive relative to holding a bunch of rocks?
Yeah, I think in general, people underestimate, well, I guess it would be overestimate. One, they overestimate the size of the metals market and how big it is really. When we're talking about the bond market, where we're talking about global stock indices, the gold market is very small relative. So once you have central banks, once you have people start to pile in for whatever reason, the reason gold shot up originally was because of what was the main catalyst was sort of when annexed Russia's stuff. And then people were like, well, if you put someone like Trump in charge and you're allowed to annex people's stuff, like, we don't want to be in dollar assets anymore. That if we're at the whim of that, then we want to go. And then you start to get this rising prices. But if you pull up a metals chart, metals are historically these blow off tops are very normal. We did it in what is the years that we did? I know we did it right after the GFC. We had a big metals boom. We had the Hunt brothers in 79. We had the huge push up higher. So it's not abnormal for markets to have these blow off tops. And to me, the gold move is FOMO. I haven't been a part of it. My systematic things have been in gold, so I benefited from it. But at 3,500, I don't want to own gold. And we're way past that. I think silver is even more ridiculous.
So what you're saying is that you're not taking any macroeconomic signal from the prices of metals.
Well, I'm taking macroeconomic signals up to 3,700. And then I think there was a real reason for that. I think this last little blow off past 4,000 is all a technical break into a small market that people are extrapolating a bunch of things that just really have to do with FOMO. But that's just my...
I love gold. I've been, ever since leaving Bridgewater, I've owned it from my personal account in a heavy allocation relative to anything else, 5 to 10%, round numbers, and most of the time. Currently, I have 9. And I broadly agree with you that I'm not taking much macroeconomic signals from it. Jimmy, what do you think?
I think the biggest thing I'm taking from is that why did it happen? These were extreme moves. They went completely parabolic. And what we could spend the rest of the year with metals digesting and clawing around and not taking out those highs, being a shitty trade for the rest of the year. But I get back to like, what caused it? What caused that rip? That was a historical rip. And I believe what caused it was when we start meddling with ideas of like, oh, we're going to run it hot, or we're going to lower interest rates into a global economy that's starting to hum a little bit. Or maybe that's those markets looking at things and saying this is extreme. This is not, you can't just do that. And then the back end of the curve, metals, these are little markets that are going to get in the way of that type of thinking. You can't just run high octane and nitrous through the system the entire time, or else you get these flare-ups. And those cause issues. One thing that's strange, but I guess maybe it was because of this weekend's a lot of geopolitical stuff going into energy and crude oil, that crude oil has stayed under 60 throughout this entire process. It hasn't joined the party at all. It's a strange thing.
Do you think that's oil producers wanting to appease Trump?
It could be.
Oil producers, like, they talking like over east or even like here or what?
Well, the ones here must be getting devastated, right?
Yeah, because I think any U.S. person is saying, I want oil down, or they would even agree to such a thing, because the average barrel is not going to break even nearly what a Saudi Arabia would be or something.
We got plenty, but it's high cost versus, right. So I assume it would be the Middle East. And there's a lot of geopolitical action going on there. Trump is more aggressive than anyone has been regarding Iran. He certainly showed his hand in terms of supporting Israelis versus Gaza. It's not to the benefit of U.S., and certainly Venezuela is not going to be to the benefit of U.S. crude producers. But it does seem to me to be, you just go back to the 333. You go back a year ago, all we were talking about is drill, baby, drill, 3 million barrels of oil on the market above what had been happening from Besson. That was one of his key things. Looking back, we didn't get anywhere close to 3% deficit to GDP. We're still running, we'll be at 6 this year, which is really no change whatsoever. And we're hot with a 3% real GDP in Q4, more than that. Q3, but it doesn't look like we're going to deliver that for over year, and it doesn't look like we're set up to. No one expects that for next year, so we're not getting any of those things. But we're sure getting the effect of lower oil prices. That's been a huge success, right?
Yeah. And I think just in general, Trump has reached out to the Middle East crew. He goes to Qatar, which a lot of people didn't go to. He goes to Saudi Arabia. Bin Salman he obviously wants to change Saudi Arabia from a Wahhabist, like a fundamental Islamic country, into a more modern one. He wants to be like a UAE. He wants to be like that. So I assume there's some sort of dealing in between the thing that say, hey, we want to go in this direction, so we will play along for a little bit. And it's really beneficial to Saudi Arabia because they have staying power. Whereas the U.S. producers don't have as much staying power because their break-even, their marginal barrel costs more.
It also impacts Russia. It helps China. But a low oil price is bad for Russia and bad for U.S. producers. But I think there's a sacrifice that's been willing to be made against U.S. producers because the overall economy benefits so much. So the question is, does it continue? And is there anything geopolitically that we would say, geez, it's time to buy oil?
I think oil is right on the edge right now. So if we get close under 56 on a daily basis, I think we go to the low 50s and test it. If you think of inflation-adjusted dollars, if you think of a low price, if you look at history, $50 is insanely cheap right now. So it should bounce. And it's not good for the U.S. And technically, this is where they need to save it. So if they're going to save the oil market, you have this Venezuela thing. I think we snap down. But that will be the tell, because we'll have that great technical tell. Bad news, good price action. If we could get a bad news and good price action, I think that's the time to buy oil right now. So if the oil opens up and this Venezuela thing turns out not to be a big deal, I think oil is a screaming buy. But if we start getting those daily closes under 56, I think we test 50, maybe even go into the 40s, and then go from there.
That's what I was thinking. I was thinking Tonight's price action is going to be a huge tell. I'm sure we'll get a gap down, but if we can hold that 55, 75, 56 area and bounce from there and actually have a strong reaction, that could start a completely different leg higher. But if we can't hold that, Nick, you're right. We're going to probably trade 49.90 or something, get that four handle printing and trade low 50s at least off this. So tonight's going to be a huge tell for the future.
So let me ask, we covered a bunch of things. The thing that we didn't cover yet is the SCOTUS decision. My view is that tariffs are illegal, but who the hell do I know? Who the hell do I think let me describe, like Nick and I like to describe consensus, which is, I don't know what consensus is, but here's my guess at it. My guess is that tariffs are perceived by market participants as good because they reduce the budget deficit. They are probably neutral to growth and inflation because we've been programmed now to think that other people pay it and that there hasn't been, that any inflationary impact that we do get is going to be transitory and that we're not going to keep increasing it, tariffs. So you ask yourself, well, if what's market sentiment with those things? You also add that we've been told, and I think rightly so, that the next step from the Trump administration is to reinstitute tariffs in legal ways. And I think there's a general expectation that any remedy for tariffs that were charged illegally will be mild and won't force the government to write a $200 billion check. So I think that's all consensus. Do you guys agree that that's the framing and the consensus?
Yeah, I think it's mixed. I think there's a large group of people that just look at tariffs as just like evil. They don't look at it like a consumption tax. They don't look at it like that. They just look at it as if like a total overreach of government. I get it. We need money, right? We need to fix the debt. You have to do something. So it's like a shot in the air to see if they could do it. But as far as the SCOTUS decision goes, it seems very mixed to me. I don't know what the betting odds or whatever, but to me, let's say they put me in that position and I was a Supreme Court justice. I don't know nothing about the law, but I think they just don't want to answer right now. I think they want to punt. I think they want to push it out. So it's like they come up with a thing, they say they're illegal, but you have 6 months to see if Congress can. You give it to Congress. It's a Congress. You give it to Congress. We'll give you 6 months to keep it. At then, it's illegal, whatever. And then see if you can pass it in Congress, and then you wouldn't have to pay back or whatever.
But Congress, and this is an interesting topic too, Congress is not going to be able to pass tariffs. You're going to get filibustered to death on tariffs. So this is an important thing that I've been thinking a lot about, which is, does Trump convince the middle of the Republican Party, because that's the group they need to do, the middle of the Republican Party, to get rid of the filibuster?
I think they do. I think it's a general consensus that people want to get rid of it. I think Democrats and Republicans essentially want to get rid of it.
I think the Democrats want to get rid of it because then they can use it when they are back in power. And right now, as when you're in the minority, all you can do is say no. You can't actually accomplish anything. It's less of a loss. But the one concern I have is that, let's say we get that situation where it's kicked back to the Congress, and I don't think they will do that, but let's say it does. Well, regardless, whatever it is, it's back in the Congress's hands. Are a bunch of farm state Republicans, going to, and for that matter, states that are more in play, are they going to vote for reinstating tariffs? It's going to be a pushed by the Trump administration. It'll be an interesting play. So I guess the question becomes, we get a negative for tariff. Well, let's say this. What if tariff revenue collections fall rapidly? What if they stay the same? And what if he wins and now can actually be more aggressive in tariffs? What do you think the market reaction to those three things are?
I think if tariffs are illegal, you get a sell-off in bonds. I think you get instant snap of the stock indices due to the rising premium of the bonds. I think in the long run, it drags down stock prices, and then that sort of takes away from the financial loop type theory. People are less wealthy. And then I think the Fed tries to step in, but you just continue to get that steepener play in the bond market. I think
similar to your view on Hassett.
Yeah. Well, Hassett, I'm not sure that we get a full steepener anymore. I think you've talked about a parallel shift down in the prices. But I think if tariffs are legal, we'll get a serious steepener. I think you could put that trade on. That's a great trade to have on. If the tariffs are legal and you think that's going to happen, I think you have a very large position in steepeners in the bond curve.
I'm not an expert by any means. This is so I don't want to, but this is my understanding. If they do deem them illegal, he does have countermeasures that he can immediately launch.
Which is what expectations are, right?
Right. And he will do that.
Well, I guess that's the question. Will he? What if he doesn't? That's when you get a major steepener. If this is the ultimate, hey, I can't do tariffs, so I'm going to stop doing them.
Yeah. I just don't see Trump quitting like that.
If they're illegal, they're illegal. You know what I mean? It's like, and that puts the thing he's doing now is he's using the law and extending it, right? Like it's supposed to be 60 days. It's supposed to be 150 days that you can do this. But he's found a loophole to make it indefinite. And so if they say that it's illegal, then it's illegal. And if he's like, well, I'm going to use this rule, well, they're going to look at the rule and be like, oh, that's 50 days, or that's 100 days, or that's a year. I don't know what the lengths are.
No, but using the various alternative options he has to institute tariffs that are legal, they are limited.
Yeah.
But the issue is that he'll buy some time with those legal versions that are limited.
So I would put that in the category of like, you could convince the stock market that, but you couldn't convince the bond market that. What's 50 days to the bond market? What's a year to the bond market? You're talking 10, 30-year bonds. It's irrelevant. I just mean in general that it's not going to hold. I think you could talk stock investors into that. I don't think you could talk the bond market into like it holds the same thing. Maybe you could, and maybe they will, but I think you have the two options. They're either legal and he can continue them, or you can get Congress to pass it. But if you don't think that Congress can pass it and tariffs come in, I think we have a massive steepener, and that's the trade.
But you don't think it's priced?
No. If tariffs are legal, I think there's a real steepener play to still play.
Right.
But I wouldn't outright buy or sell bonds. I would play the steepener. I would play.
Right. They are not steep by any stretch of the imagination.
Yeah.
So you could talk about 120, 2.5 to 250 is the widest they tend to get. But, there's plenty of room for a steepener. I'd agree with that. Okay, well, we covered a bunch of things that were on my list. Are there any things on your list?
No, I guess the only thing that is going to be a common sentiment issue is, are we at the top of the AI bubble? And will we be able to rotate into other sectors and start seeing things like productivity gains? Will we start to see other things besides just massive investment in data centers? The ball's in the air. I'm an AI believer, but as far as stock prices go, I never try to link those things because throughout history, stocks behave differently than the actual outcome. The internet was the best thing to ever happen, and it took many years, and we went through one of the biggest corrections in history. Everything they said came true. It just took a lot longer, and everything else.
For me, the AI TAM is still about where does it come from? Where does the GDP driver come from? The only way it really works is if all the people that are displaced by this technology, which, by the way, I use all the time, and I think it's great, but it's also free, essentially free. So nobody's making money on it.
My credit card bill would disrupt that.
It costs something, although I have to admit I get plenty of value out of what I use for free. But anyway, it's free relative to what's being spent. Let's just describe it as that way. Relative to the investment, it's free. But assuming they're going to have to generate revenues, and if they're generating revenues, it's coming from something. It's coming from other sort of spending. So I always wonder about the TAM of this technology. But, I think I'm a believer too, so it's a matter of the, what I would call the fits and starts. Like, if you really looked 20 years from now, is AI going to have a major impact on the global economy? Yeah, probably. But does that help you trade stocks in the next year? No, not at all.
I guess I just still hold the view that you should raise cash into rallies and buy the dips. That would be the outlook that I'm
To
looking
see this year. We get non-farm payroll on Friday, don't we?
Yep,
Is it an old one or is it current? So
it's current.
right. So I think that's going to be the kind of macro theme that I really want to see play out this year. Is employment softening? Is it softening because of AI? Is productivity? I think we get productivity on Thursday as well too. So
Yeah.
are we productivity gains from it, and
I
how
can't
this
imagine
all works out in
really.
society?
I don't think productivity is likely to show a lot of AI benefit. We haven't seen the job losses from AI. We can see potentially a slowing of hiring, but an actual reduction in the workforce and significant wage declines and all that, that's where the productivity boost is going to come from. I don't think we're going to get it anytime soon. Maybe we do in 2026, but I think the employment number is going to be, as I said, you can't do much with this data, but it would be an interesting environment in which there is some chink in the armor of a relatively healthy economy, certainly for stir.
Yeah. And I think that's the method, like as opposed to trying to guess when FOMO will end, being in the stir market, looking for the steepener plays, looking for more macro edge. The only other thing I could possibly think of that we could just cap on real quick would be the rest of the world. South Korea had one of its best years ever. Europe did very well. We could still see this global rise in stock indices, which the U.S. underperforms, but at the same time is dragging the global economy up.
I'll say what has been true is I think we've at Damp Spring have called this right, that we've been favoring. I don't play the emerging markets. I don't play developing economies, but we've been in foreign stocks, rest of world stocks, developed markets, which is largely Europe, Japan, for all year as over the U.S. And we've won in two ways. One, the stocks themselves have done well. If you look at tech stocks and you say, wow, they've done great in the U.S., and then you just look at European banks, they've crushed them. But you don't have to be in tech stocks. And on top of that, you've had the dollar working for you. So going into 2026, I'm still leaning in that direction. I think that's a broader topic that we should come back next month, and let's talk about that. So this is the first time we've done this. Damp Spring offers the DS Alpha product, which is our macro longer-term investing product. We offer DS Data. Daniel wasn't able to join us today. That is a product that allows you to utilize us as your rent-a-quant to answer complicated macroeconomic questions. Within DS Alpha, we're launching a DS Stocks product, which will be just an add-on extra from the DS Read product, in which I'm going to be focused on event-driven stock picking, not picking stocks, but when there's a significant event, a equity index rebalance, a merger and acquisition, something in which a capital structure like MicroStrategy, the DATS versus crypto, something like that is interesting to me. I'm going to be explaining trading opportunities in that space. And so at some level, this is an opportunity for you to get to know us. Jimmy and Nick run another service. You want to give a blurb on that?
Sure, yeah. We run a service we call DSMMA, and in it we run systematic portfolios. And so essentially we're giving people who don't have access to massive amounts of quantitative information. We release that every day. On top of it, we do short-term trading strategies in all the main future assets, currencies, bonds, commodities, and we put out daily levels and commentary on shorter-term trading. So our focus at DMSMMA is systematic and the short 2 to 4 week type trading, as well as we release a series of different indicators if you're a day trader, if you trade bonds, if you trade the stock indices. We do systematic and short-term trading strategies. Me and Jimmy are available. It's a fantastic product. People have loved it so far, but we're looking to expand and reach out to more customers.
And overall, I think what we all agree on is that owning long-term owning stocks, bonds, a variety of diversified assets is the best way to save for the long term. And that while we do offer ways to tweak that, to outperform standalone alpha opportunities where you can try to beat the market, we want to reiterate that owning assets long term is probably best for most of you, and we help you understand that. Our products are designed for education, but they're also designed to keep you highly informed about what's going on in markets and to advance your understanding of markets. So that's this month. Next month, so hopefully you got to know us a little better and hear what our thinking is. Next month, we'll be updating our views, reviewing where we made bad calls, and looking forward. I hope you enjoy it.